Warren Buffett has come out with Berkshire Hathaway's annual shareholder letter. These are seminal texts in the world of business. Warren Buffett writes these annual shareholder letters himself. He doesn't just have some investor relations person do it. And they always are full of wisdom and nuggets. And this year, a few things he said have garnered attention. Specifically, when talking about Berkshire's expected performance in 2024 and frankly beyond that, Warren said this: all in all, we have no possibility of eye-popping performance. What he's saying here is Berkshire Hathaway isn't going to have crazy returns, crazy growth, crazy change from where it is in terms of its stock price or otherwise, which on the surface is kind of an interesting thing to hear from a CEO and chairman. Now, a lot of people have been reporting on this, and Jason Calacanis, who is a venture capitalist and an early investor in Uber, I say it like that because the joke is that Jason Calacanis talks all the time about how he was an early investor in Uber. In any case, Jason Calacanis tweeted this. He said, Buffett says all great companies that he could take over or invest in with his enormous cash pile have already been picked over. And big tech is spending their cash hoards on H100s from NVIDIA since Lina Khan FTC won't let them buy companies anymore. Market is stuck in the mud. So for today's episode, I wanted to talk a little bit about this tweet. I want to talk about Berkshire Hathaway and their annual shareholder letter, and why there are a bunch of investors out there who feel just this way, that the market is stuck in the mud. Hopefully you come away from this episode today with a slightly better understanding of some of the macro dynamics happening in the broader economy, but certainly the American economy specifically. Let's start with Berkshire Hathaway, because yes, while it is true that you will not see the kind of four-figure returns that the crypto generation has gotten used to seeing in like a week, where you can buy some shitcoin on a Monday and by Friday it's up 2,000%. You will not see that if you buy Berkshire Hathaway stock. But far from being a sign that Berkshire Hathaway is failing in any way, it's actually because Berkshire Hathaway has done so well. Berkshire Hathaway last year did $97 billion in profit. That is an insane amount of money. And the truth is, its size, Berkshire Hathaway's size, is the biggest limiting factor in its ability to make these eye-popping returns. Berkshire Hathaway has had so much success, they have acquired so many companies that have been successful, that they are so big now that the opportunities they would need to actually move the needle to make their revenue markedly improved, to make their profit markedly higher, those opportunities simply do not exist. Even if they find an opportunity in like a public market, even if they find stocks that they do want to buy, a company whose shares they want to buy, they are so big that to buy enough of the stock to make a difference for them, they have to do it over a longer period of time, because if they bought it all at once, they would move the market. They would move the stock price up because they would be buying in such bulk and such volume. Warren Buffett in this year's shareholder letter described it as trying to turn a battleship, this arduous process where it takes the prices have to stay good for them for a longer period of time so that they can actually spend the time they need to buy it to turn this battleship. But the second problem for Berkshire Hathaway, which is one that Jason Calacanis was referencing in his tweet, is this idea that the companies that are big enough for Berkshire Hathaway have already been picked over, which is partly a function of the investing environment just getting more competitive nowadays. Now, in this year's shareholder letter, Warren referenced this as well. Warren has described how in the past there were an abundance of companies that Berkshire could potentially acquire, take over, invest in, etc. But he said, quote, those days are long behind us. Size did us in, though increased competition for purchases was also a factor. So again, referencing the size piece that I was just talking about, but also talking about the fact that it is a more competitive landscape now. And Charlie Munger, RIP, Warren Buffett's longtime business partner in Berkshire Hathaway, Charlie, in the months before he passed away, actually gave a number of interviews, and he said something similar. He talked about how it has just gotten more competitive out there, and it is just increasingly difficult to find the kind of good deals that propelled Berkshire Hathaway for the last 5 decades. And as the investing landscape gets more competitive, potential gains get competed away, and it can create this feeling like you're kind of stuck as an investor. It's hard to find really good opportunities. And that contributes to this sense of the market being stuck in the mud, this sense of paralysis. But now Berkshire Hathaway is unique in a number of ways, but they are certainly not the only big company facing these challenges. And there's other reasons for it too, which brings us to the second reason, and the second reason that Jason Calacanis referenced in his tweet for why some investors feel that the market is stuck in the mud. And that brings us to Lina Khan, who is the chairwoman of the FTC. Now, the FTC is responsible for overseeing a whole number of things, including antitrust law. So they are in charge of allowing mergers and acquisitions to go ahead and making sure that no business gets too large, that they are essentially monopolistic in an area. Now, Lina Khan, who is the current head of the FTC, the youngest head of the FTC, her arc, whether you consider it a hero arc or a villain arc, depends on who you are, but her arc really starts in 2017 when she was a student at Yale Law School who wrote a paper called Amazon's Antitrust Paradox. And this paper really put her on the map. I mean, her fundamental thesis here was that the old framework, the old paradigm for antitrust, which was always centered around consumers, was really outdated. So the idea is that in the old world, it was something was monopolistic and negative, and antitrust should come in and break something up if it was harming consumers and driving prices higher, right? A company goes along and becomes the single jeweler in an entire state. It has monopolistic practices that can raise the price of jewelry. That's a harm to consumers. But in the modern era, in the big tech era, you could actually argue that a lot of these tech companies have driven prices lower for consumers, but their consolidation, Facebook buying WhatsApp, Facebook buying Instagram, has actually done other harms to society and other harms. They're too big and they're too powerful, and they're harming consumers in ways that are separate from price. So that was the fundamental thesis for Lina Khan's paper, Amazon's Antitrust Paradox, and it really caught a lot of people's attention, including President Biden's, which is why he named her the youngest FTC chair ever. And a lot of people, I think, actually agree with Lina Khan and agree with her fundamental thesis there. Now, as head of the FTC, she gets to make decisions about what mergers and acquisitions the FTC will challenge, and many feel she has gotten a little bit too heavy-handed in that role. And whether you love her or you hate her, Lina Khan has definitely had an effect on the mergers and acquisitions landscape in this country, which then has ripple effects throughout the investing landscape. Now, interestingly, Lina Khan's record in court when she challenges a merger or an acquisition in a legal case, her record is quite poor. She's lost every court case the FTC under her has brought. However, she'll note that 19 different deals, so mergers or potential mergers or acquisitions, were canceled, were abandoned when the FTC challenged them. When the FTC said, hey, we're going to take issue with this, we may bring a legal case about this, the parties involved dropped the case altogether. So even if she's not always winning a court case, she's winning at earlier stages in the process oftentimes. As I said, this has ripple effects. It's not just about mergers and acquisitions that get blocked, but it also then trickles down into other parts of investing and, you could argue, the economy. So for example, after Lina Khan and the FTC went after a series of biotech and pharmaceutical companies last year who were trying to merge or acquire other companies, biotech investment was down 25%, which was very much spurred by investors being afraid to invest in a company that then is going to be stymied by the FTC. So the idea is if there's a company that you think is maybe a good candidate to eventually be acquired, you might put money into that company because you think, okay, the exit opportunity is that it's going to be acquired by somebody else. But if you now think, oh, the FTC is not going to let this company be acquired by any of the major players that actually could acquire it, I don't want to put money into this because I don't think I'm going to be able to get my money out at any point. And so the detractors to Lina Khan would say, well, the effect of that is you have fewer drugs being developed and fewer drugs going to the market. And whatever we may think about big pharma, obviously we all support medication and we all want effective medication out there. And so detractors of Lina Khan would say the effect of what she has been doing, of having this very heavy-handed approach to the way that you regulate with the FTC, this is the effect. You have fewer investments getting made. You've got less innovation happening. And this is having a market is stuck in the mud paralysis effect on the landscape. And speaking of investors not investing, this leads us to our final point, the final reason that I think there is a sense that the market is stuck in the mud. And this has to do with the IPO market, the initial public offering market, the way that private companies go from a private company to a public company. Folks may know, they may not, the IPO market has been definitely stuck in the mud for the last 2 years. In 2022 and 2023, there was 181 and 154 companies that IPO'd respectively. So in 2022, 181 companies IPO'd. In 2023, 154 companies IPO'd. In 2021, 2 years prior, 1,035 companies had IPO'd. So the drop off from 2021 into 2022 and 2023 was steep, precipitous, the amount of companies that didn't IPO versus the amount of companies that historically had IPO'd. And of course, the reason for this is multifold. The big immediate reason is that a lot of private companies raised money at a really crazy valuation, and that happened during the zero interest rate era, the ZIRP era, as it gets called, during the pandemic when money was free flowing, and these valuations got really out of control. And so they would go public at a valuation that was less than what they previously raised money at. And companies really don't like having what's called a down round. They don't want to go public for less money than they were worth when they last raised money. But again, a dearth of IPOs means that there's kind of this feeling that things are sluggish right now, that things are stuck in the mud, that the pipes are clogged and things aren't getting through. Now, this is very possibly going to change in 2024, and you're starting to see an increased interest in IPOs and companies that are interested in IPOing in 2024, including Reddit, which has filed the paperwork saying that it will be IPOing in 2024, which is quite interesting. Now, ironically, some of these things are feeding one another. So the fact that the mergers and acquisitions market aren't doing very well is part of the reason that companies are interested in IPOing. You have companies who need to raise more, that are hitting the end of their line in terms of the money they've raised privately. They would have to take a down round if they raised again privately anyway. And I'm reading from a Barron's article now, IPOs have become an increasingly appealing option given a weak mergers and acquisitions market and reluctance to take on new venture money at reduced valuations. So again, the idea being that, okay, I have to take a down round if I do an IPO, which is not ideal, but that might be preferable to doing a down round in a private market where I may not be able to get the money anyway. And because there's no mergers and acquisitions activity, there's probably not an opportunity there for me to be acquired. So let me try and go to the public markets. That's the best of the options that I have. Now, of course, all of this, the big umbrella that overhangs all of this is the question about interest rates. With interest rates high, it is natural people are going to feel that the economy or investors are going to feel like things are a little bit more stuck in the mud. Now, the umbrella that overhangs all of this, of course, is interest rates. With interest rates up, it is only natural that investors are going to feel that things are a little bit more stymied, a little bit more stuck in the mud. Everyone is waiting to see when the feds will start lowering interest rates again. It's expected to happen this year, certainly. But interest rate policy is the thing that drives the rest of this in many ways. And it'll be interesting to see what happens if and when the Fed do start to cut. All right, folks, that is our episode for today. If you did enjoy this, please consider subscribing to the channel, liking the video, commenting below. I love hearing from y'all. And with that, I'll see you next time.